Hello, I'm Roger McEowen with the Agricultural Law and Tax Report. And today I'd like to talk about the top five, as I see it, top five legal and tax issues that farmers don't think about, but should. And some of these have sub issues to them, but these are all important issues. Obviously, tax and legal issues are very important to the bottom line of a farming or ranching operation, but there are some issues that are not as noticeable as other ones, and we may tend to forget about them. And that's what I want to focus on with you today. Let me start with the first one. Here I have tax complacency. I have kind of a number of these under the category of miscellaneous tax and estate issues. So I've got some subcategories here. But number one is miscellaneous tax and estate issues. And tax complacency is, I think, a big one, and particularly on the estate tax side of things. For years, farmers feared that the 2026 sunset where estate exemptions were expected to drop slightly, uh, to slightly over $7 million, basically being cut in half. But the One Big Beautiful Bill Act set a new permanent exemption for 2026 at $15 million, and that will be indexed for inflation. So that will continue to rise. And when we get into 27 and 28, and it would take an act of Congress to reverse that. And that's per individual, and it is coupled. And what I mean by that is you can use that exclusion to offset taxable gifts during life. And to the extent you don't use it to offset taxable gifts during life, it's available to offset estate taxes at death, federal estate taxes. Now in Kansas, we don't have to worry about any state level taxes associated with death. If you're in Nebraska, you do. Nebraska has an inheritance tax system, but no other state that borders Kansas has an estate tax system or an inheritance tax system. But the overlooked issue here is with that exemption being so high. In fact, when I started practicing in North Platte, Nebraska in 1991, uh, the exemption was $600,000. Well, we've come a long way since then. We're at the highest it's ever been. And I never thought I'd see an exemption of 15 million. But with it at that level, many farmers and ranchers and others may be tempted to not do estate planning because they believe they're under the limit and there's no possibility of estate tax. But many farmers, there's two things here with respect to this. Many farmers underestimate their asset values, and a modest farming operation can push the present exemption limit. You take let's take a modest size or an average size Kansas farm or ranch. You add up those values in terms of the land and the equipment and the livestock, and you're easily there just on a modest one, $5-6 million. Now I know there's still a lot of room left to go to get to 15 million, but that's just a modest one. I have handled estates in Kansas that are over 30 million, and they're out there. There's not a whole lot of them, but if you're in that stratosphere, a 40% tax rate is a big bite to come out of your estate if you have it planned. Now, of course, there is the unused exclusion at the death of the first spouse that can be ported over and added to the surviving spouse's existing exclusion at the time of death. But you've got to file a Form 706 to be able to port the uh, deceased spouse's exemption, a remaining exemption, over to the first spouse, even when no tax is due. So, and that's probably always a good move. Keep that in mind. So, if that situation presents itself to you, you probably want to have the lawyer that's handling the estate go ahead and prepare a 706 for the deceased spouse's estate, even though no tax is due, for the purpose of porting any unused exemption over to the surviving spouse. Now, that unused exemption will not adjust with inflation. So if the deceased spouse's estate was 10 million, you've got 5 million of unused exemption that adds on to the surviving spouse's exemption, and that 5 million stays fixed. That will not get an adjustment. But the the problem of not doing estate planning because you think there's no issues with tax, really for most estates, the issue's not tax, it's basis. And that's my second subpoint here. If we mismanage a step up in basis, that's a big deal. Everybody is concerned about basis. Every estate is concerned about basis. And think how good we've got it on the estate planning side of things right now. We have the highest ever exclusion, applicable exclusion amount of 15 million. We have the ability to port over an unused exclusion at the death of the first spouse to the surviving spouse. And we get step up in basis for assets that are included in the decedent's estate. So the recipient of those assets gets a new basis at death, which if they sell those assets, then that can wipe out, eliminate, or substantially reduce capital gains tax, because the capital gains tax would be computed on the difference between the selling price then of that inherited asset and the value as of the date of death. And I think that's this basis step up is the single most valuable tool for farm families. It resets the cost of the land, and I'm just focusing on land in this example, to its fair market value at the time of the owner's death. And that's going to be typically the number one asset in terms of value in a farmer's estate. The other thing that I think is overlooked in this context is gifting land or gifting assets to children while they're still alive to get it out of the estate. And that we don't do too much gifting for clients today. Where gifting comes into play is when we have an estate that is above the threshold and we're trying to keep it under, and we're using techniques to trim that value out, or when we're close and we have appreciating assets that might pop us over that exemption limit. The problem is you get a different basis rule on gifted property. So on gifted property, the donor's basis carries over into the hands of the donee. So it's often better, in my view, to transfer operations during life, but transfer land ownership at death. So you can transfer other assets that are not the big asset, like land. But remember, you're going to have that carryover basis on those. But that may not be as damaging if you want to make gifts during life from a basis standpoint to the heirs. The other side to this is you'd say, well, if I transfer my operation and my land to my children, the lack of a basis step up presents a pretty substantial disincentive for them to dispose of the assets because they would get hit with the capital gains tax. But, that's, do you want to take the risk of losing those assets outside the family by your children losing them to creditors or selling those assets or doing something that would take it out of the family line? And that's a big issue for some. It may not be an issue for others, but that is a big issue for some. So I think that's the overlooked issue. Another overlooked tax issue, and I'll put it in this category in terms of tax, is I call this doing a checkup for the QBI deduction, the qualified business income deduction. That's your 20% deduction of your qualified business income, not your capital gains, but your qualified business income if you're not a C corporation. Recall what Congress did in the Tax Cuts and Jobs Act. They lowered the corporate tax rate to a flat 21%. I say lowered, I put that in quotes. It may not actually effectively be lower, but it's a flat 21% rate. And so you didn't get the graduated rates that could pop up over 37% for some of that income. But basically, the top rate for C corporations was 35%. So it's come down to a flat 21% from the first dollar out of the box. And to benefit non-C corporations, the Congress created a 20% pass-through or a 20% deduction on business income for pass-through entities, sole proprietorships, other entities that are not C corporations. Now, there's a nuanced overlooked issue here. The deduction is limited by the amount of W-2 wages the farm pays or the basis of property it owns. So if you have employees, you've got another calculation, you get another set of things to think about in terms of the calculation of your QBID. Now, many farms will operate as informal general partnerships or sole proprietorships that don't pay W-2 wages to family members. You can still get the QBI deduction. All I'm saying here is you might want to have your tax professional look at this. If you are in need of employees or you have employees, make sure that calculation is being done correctly so that you're maximizing your QBID. Or if you're considering employees, you need to factor in some considerations as to how that will impact your QBI deduction. It could increase it in certain situations, but then you're going to have to balance having W-2 employees with the cost of having employees from a tax and a financial and a liability standpoint with what it does to enhance your QBI deduction. It may not actually work, But I just want you to think about that. The strategy here would be to transition to an S corporation or a structured LLC that pays reasonable W-2 wages. That might be able to unlock a larger QBI deduction. And also in 2026, there's a new $400 minimum deduction for small producers. I know that's not much. We just don't want you to fail to claim that. Again, we're trying to maximize your bottom line, and if you don't have to pay any more tax than is legally required to the government. So you don't want to miss that one in 2026. That was in the OBA. Another subpoint here under tax, miscellaneous tax issues, would be the machinery trade-in tax trap. That's what I call it. Now, TCJA changed the rules on 1031 exchanges. Those like-kind exchange rules no longer apply starting January 1 of 2018 to equipment. It only applies to real estate. Now, you'll trade equipment, farmers will trade tractors and combines, they'll trade that, but it's no longer running through a Schedule F. That's treated as a sale. That gets reported on Form 4797. On the Form 4797, it does not pick up self-employment tax. So your bottom line tax liability that's owed may actually be less as it's coming through a 4797 compared to when it was running through a Schedule F because there's no self-employment tax. So when you trade that $300,000 tractor for a new tractor, the IRS treats it as a sale of the old and a purchase of the new. So if you've already fully depreciated that tractor out, using bonus depreciation using Section 179, and that sale triggers what we call depreciation recapture. That's Section 1245 of the code. That gets taxed at ordinary income. So whatever your ordinary income rate is, that's the rate that's going to apply in that situation, not your capital gain rate. And it's all due upfront in the year of sale. That's front loaded. So that be careful with respect to that. Now, bonus depreciation is back to 100% for assets acquired and placed in service on or after January 20 of 2025. But if you don't have enough purchases to offset the gains from your trades, you could experience an unexpected tax bill. So again, talk with your tax professionals on this machinery trade-in tax trap. Make sure your transactions are structured properly. That's one that can be overlooked. So be very careful with that. Another subpoint under tax would be ignoring fair versus equal in operating agreements. Now, many farmers will often leave land to all the children equally or in a will or a trust, but there's a difference between equal and fair. And I know you've probably heard this before, but I always want to keep it in people's minds. What you want to avoid is a partition lawsuit amongst the heirs. Okay? That's the leading cause of family farm liquidation. And if you leave all of your land, for example, equally to all your kids in co-equal ownership, and you've got some that are on farm heirs and some that are off farm heirs, that's ultimately going to present a problem because the off-farm heirs, in many instances, will become frustrated. That's a dead asset to them. They want income out of that. Now, not in every situation. Every situation is unique, but that is a problem, and you want to be aware of that. So one way you could deal with that is to move that land into an entity such as an LLC with an operating agreement that is pretty precise. And that would include a buy-sell provision in it that allows the farming heir to buy out the siblings at the land's agricultural value rather than market value, or also structure the buyout with long-term payments, maybe over 15 to 20 years, so that the farm's cash flow can handle that debt. Then there's another subpoint I hear still under tax. I got two more under the tax heading that I think are unknown. See, this is how you label a document, five things, and then you come up with subpoints so you actually cram in more. But I would say the active participation trap in business structuring. A lot of farmers and ranchers will use a landlord-tenant setup where the operating entity rents land from them personally or from a separate landholding LLC. Now, if that's not structured correctly, and I'm cutting through a lot of stuff here, but if that's not structured correctly, there's case law going back to a problematic case in 1995 that really didn't get corrected until 2017. And the IRS, if we don't have it structured properly in accordance with the 2017 case, then the IRS may recharacterize that rental income as self-employment income, and then you get hit with another 15.3% tax if the owner is deemed to be materially participating in production. So smart structuring involves a manager managed LLC or an S corp to bifurcate the labor income from the investment income. If we fail to do that, that often results in farmers paying thousands more in Medicare and Social Security taxes than they are legally required. So you don't want to miss that one. Again, we're trying to fatten that bottom line as much as we can by minimizing the amount that is lost because of taxes. Then the last item I have under my number one category, which is taxes, is not structuring the business properly. And that's from a self-employment tax standpoint. That's from a liability protection standpoint. That's also from a standpoint of getting that step up in basis and maximizing that QBI deduction under Section 199A. So if I'm a sole proprietor, I'm paying SE tax on all my net income. I don't have any liability protection. I do get a basis step up in all my assets because they're in my estate. Now, normally that won't present a problem unless I'm really close or over the exemption level for federal estate tax purposes at the time of death. And my QBI deduction is pretty easy to claim. Now, if I have an LLC that's treated as a pass-through entity tax-wise, then self-employment tax is paid on all the net income. I have full liability protection, basis step up, still get that. And to maximize the 199A deduction, I would want to probably look into paying some W-2 wages. Now, for an S corporation, there's your SE tax savings because you only have SE tax on what the reasonable compensation is paid to the owner. The distributions, the other distributions or draws that are received out of the S corporation are not subject to SE tax. And so with our wage base being 184.5 for Social Security purposes in 2026, if my salary is set at half of that, then I'm effectively saving, the way it works, about 12.4% of effectively $90,000 or 92,250. That's still a big chunk. That's still over $10,000 that you're saving every year. I have a fear that a lot of people are letting this slip through their hands and their tax liability is higher than it should. You get full liability protection. It applies only to the stock in terms of the basis step up, and you have the strongest potential for achieving a 199A deduction. Let me do one more here, and maybe we'll take a break and break this into two videos for you, or maybe I'll just keep rolling here. But ag labor compliance and the joint employer standard. This one it doesn't apply to everybody. But when it does apply, a lot of people miss this one. This is a hidden regulatory risk that involves ag labor. So farmers frequently share labor or use custom harvesters and labor contractors. Now, under the Fair Labor Standards Act and state laws, a farmer can be held liable as a joint employer for the wage and safety violations of third-party contractors. So if a custom harvester or a labor boss fails to pay overtime or meet safety standards, then the farm owner can be sued for back wages. Now, in just some of your maybe watching this are from Colorado, in 2021, Colorado passed aggressive labor protections, and that's SB 21-087. That removed many traditional agricultural overtime exemptions. So producers who cross the border from Kansas or Nebraska into Colorado with their crews often fail to realize they're suddenly subject to different wage and hour math on this issue. So you want to ensure that all of your custom work contracts include indemnification clauses and require proof of workers' compensation and compliance with the Fair Labor Standards Act from the contractor. The third one I've got on my list is water right abandonment and compact compliance. So when we're in Kansas, Western Kansas, Nebraska, Colorado, points west and south, southwest, the water is it's a legal property right, and it can be lost in many of these states through non-use. So I think the thing that's overlooked here is that farmers in Colorado and Kansas are subject to the use it or lose it doctrine. So if you stop using a portion of your water right or stop using all of your water right, perhaps due to a shift in crop rotation or conservation efforts, or whatever the case might be, the state might determine that you've abandoned your right. Well, you don't want to lose that water right. That has a distinct impact on the value of your property. So let's look at this abandonment clock. The most immediate difference is how long you can leave your water untouched before the state starts asking questions. Now, in Kansas, it's 5 successive years of non-use. And the trigger then is it's automatically deemed to be abandoned. But the state will have to prove non-use. And if the owner can show due and sufficient cause, this is kind of the conservation provision that's in the law. I didn't need to use water. There was sufficient rainfall. I shouldn't use my water right in that instance because there's been plenty of water. Now, that's been the situation in Kansas over the past year. The western half of Kansas, for example, has gotten more water and more rainfall than the eastern parts. Indeed, the IRS drought county list that came out near the end of September, those counties from Kansas that were on the list as drought counties were predominantly in the eastern third of the state. It's just kind of flipped around. It was a little bit backwards. Now in Colorado, you have to show 10 successive years of non-use. And then what is triggered then is a rebuttable presumption of abandonment. So the state will put you on an abandonment list, and then you're going to have to prove that you intended to keep the right. So it's a little bit different than the way it's treated in Kansas. All of the states have their own water laws. Nebraska follows what's known as the correlative rights doctrine. So there's a linkage between groundwater usage and surface water usage. That's unique. Other states don't have that. And then, of course, if you're farming or ranching above the Ogallala Aquifer and you're drawing out of the aquifer, in Kansas, we've got more layering of rules that you have to pay attention to. But the overlooked thing here is just inadvertently, and I've seen this happen in numerous occasions, inadvertently not using a water right, and then the state starts asking questions, or you're over pumping a water right. There are certain procedures that go through that you have to go through with respect to that. So watch your water rights. Now in Colorado, as I said, there's the intent factor. Colorado, non-use for 10 years is not an automatic death sentence for your water right. The state has to show both non-use and intent to abandonment. So every 10 years, next one coming up in 2030, the state engineer publishes a list of rights they believe are dead. And so you can fight to stay off that list in Colorado by showing no intent to abandon. So you maintained your head gates, your ditches, your pumps. In other words, if you were going to abandon it, why would you fix your pump? That's pretty good evidence. Leasing the water to a neighbor or a water bank, and then good faith efforts to sell the water right. In Kansas, you got to show due and sufficient cause. It's stricter than Colorado. So after 5 years of non-use, the right is deemed abandoned unless you can prove due and sufficient cause. And again, you've got that conservation defense. Some call it the rain defense. Adequate moisture is a defense. So if it rained enough, you didn't have to pump, as I said earlier, for 5 years, you haven't abandoned the right. If your farm is in an area where the aquifer is closed to new appropriations, which is very common in parts of the plains in the West, and it's common in Western Kansas, the law is more lenient because the state doesn't want to punish you for saving water in a depleted zone. But there is a conservation trap. That's the biggest issue for farmers. You don't want to miss this one. If you install a highly efficient pivot or drip irrigation system that saves, for example, 30% of your water, or if you enroll in a fallowing program where you have land that's idle, are you losing that 30%? That's the question. So both states, I'm comparing Colorado and Kansas, can declare partial abandonment. So if you have a right for 500 acre feet of water and you only use 300 for a decade, the state can permanently reduce your right down to 300. So to prevent this problem, there's the concept of water banking. So farmers in Kansas and Nebraska will often use water banks or conservation programs. So if you enroll in a approved state program, that tolls the clock. And what I mean by that is the years you don't use your water while you're in the banking program doesn't count toward the 5 year in Kansas or 10 year in Colorado abandonment period. So be careful here. Just don't miss this. If you're shifting crop rotations, you're trying to conserve water, there's some steps you need to take. And I think these are often overlooked. File for a suspension of use, maintain your infrastructure, and document why. that you're not pumping. Keep records showing it was due to high rainfall, broken equipment being repaired, economic hardship. All of those can serve in Kansas for due insufficient cost. All right, the fourth common overlooked feature that I will just mention here, sales and use tax exemptions on what I call dual use equipment. This gets confusing. And again, states are different in terms of their state sales tax, sales and use tax exemptions, but items like ATVs and lawnmowers and tools and certain building materials are frequently flagged during state audits in Kansas, Nebraska, Colorado, as well as other states. So I think the overlooked risk here is if I'm using an ATV, 60% for checking my cattle and 40% for recreation or hunting, that may void the exemption. So state auditors are increasingly aggressive about checking for personal use on tax-exempt ag purchases. I just want to raise that to your attention. That one tends to be overlooked. And most producers and most of those that I've worked with don't keep a log of equipment use. But if you have a simple logbook that shows your ag use versus your personal use for dual purpose vehicles, for example, that's going to be essential to defend you against a Department of Revenue audit. The fifth one that I'd say is overlooked involves fencing and boundary liability gap. In places of the country, such as the High Plains and the West, fences are pretty important in a rural area. They're also important in the East, but we're talking about larger acreages out here, and problems can be bigger. Good fences make good neighbors. I forget which poet said that. That might have been Mark Twain or somebody else. I'm not sure. Maybe Will Rogers. But that's only true if you understand who's legally responsible for the good part of the fence. Boundary disputes are a top cause of litigation when land is sold or inherited. Just on my own place, north of Topeka, my guys that work for me found a corner post that they found where it was laying in the ground. It was rotted, but we found the remnants of the fence. And it's in an area, it's kind of like a wildcat area. I don't think a human has been in that area for quite some time. And it took quite a while to pound through the brush to get there, but they found it. And there's probably a marker there, a survey marker someplace. And but this is not uncommon in agriculture. So these boundary disputes, how do we solve them? Well, we follow in common practice in Kansas and many states the right hand rule. Well, that's a statutory duty. Most farmers are going to follow that right hand rule. Two neighbors facing each other, midpoint of the fence, each maintains the half to their right. But the overlooked issue is that's a custom. That's not state law. That's not a recorded legal agreement. So if a new neighbor moves in and refuses to follow the custom or the handshake, that's not going to hold up in court. So in Kansas, for example, the risk here is that the law is going to require, the statutes are going to require adjoining lands to build and maintain partition fences in equal shares. And so if your neighbor doesn't graze livestock, but you do, you may be still liable to force contribution, or you might still be able to force contribution for the fence, but the process requires formal fence viewers to intervene. In Kansas, those are your county commissioners. In Iowa, those are the township trustees. Fence law in every state is different. And you get into Missouri, and they have a fence law for every county. So it's confusing from state to state. And related to that is liability for escaped livestock. So the legal consequences of a downed fence vary widely across state lines. And that is particularly true when we compare Nebraska, Colorado, Kansas, Missouri, Iowa, Oklahoma. They're all different. Kansas is a fence in jurisdiction. So the livestock owner is liable for trespass if animals escape due to negligence. So you're not strictly liable for animals when they get out. But open range counties in Colorado, for example, utilize a fence out rule. So a landowner can't recover damages for crop loss unless they had a lawful fence to keep animals out. The overlooked issue on that one is if your livestock escaped through a portion of the fence that was your neighbor's responsibility to maintain, are you liable for resulting car accidents on the highway? There are lots of cases on this. Generally, the answer is no, but you got to watch the facts pretty closely. The other one that I'll throw in here just as we conclude here is adverse possession and fence creep. A fence that's offline for a certain specified amount of time. That could be in some states 2 years, in other states 20 years. But basically, you want to think of this as 10 to 20 years, can eventually become the new legal boundary. And so the risk is that farmers often place fences where it's convenient. For example, around a rocky outcrop or a creek, instead of putting it on the surveyed line. Well, over decades, that convenience fence could result in the legal loss of acreage through adverse possession. So you want to be clear when you do that with your neighbor. Get something in writing recorded in the courthouse, just so that people know that you're not intending that as a boundary. So maybe every 10 years or before any major fence reconstruction, verify your boundaries with a GPS survey. If a fence has to be offline, then execute a permissive use agreement with the neighbor stating that that fence is just for convenience purposes. It's not, we're not signaling a change in the boundary, and that prevents a claim of adverse possession from ever starting. So again, those are the top five. I've got the miscellaneous, what I see as the top five legal and tax issues that farmers don't think about. Miscellaneous tax and estate issues. There are a bunch of subpoints with respect to that. Ag labor compliance, the joint employer standard, water right abandonment is the third one, sales and use tax exemptions, and then issues with fences and boundary lines. So I hope you found that helpful. Hope you found that useful. Again, we want to protect your bottom line for your farming operation, and you don't want to get involved with lawyers to the extent you don't have to. Of course, they're needed for tax and estate planning purposes to protect that bottom line. But liability issues and regulatory issues, you want to do your best to be up on top of these and not forget these and not overlook these. So again, thank you for watching. I'm Roger McEowen with the Agricultural Law and Tax Report.